Today I want to discuss what is the business cycle, what does it mean, how do you use it to your benefit to increase your profitability going into various phases, and how to protect against economic recessions or contractions. If you oversimplify business cycles, it's pretty much you have expansion and you have contraction. So expansion is broken up into three parts: recovery, mid-expansion, late expansion. And then recessions are basically when GDP is declining, and the expansion phase is when GDP is increasing. So as you come out of a recession, so we had a recession in about 2001, from 2007, 2008, and we're probably heading towards a recession in the next year or two, I would say probably by the end of 2020. When you come out of those, what you start to see is the yield curve starts to steepen, meaning that the long-term yield or height or the interest over longer CDs or bonds or treasuries is more so than that of short-term. You'll start to see GDP increase as you're expanding. You start seeing hiring. There's more jobs available. Incomes start to rise, start to spend more money because they have more money to spend because everybody's starting to become fully employed. Then when people are fully employed, you start to run into issues with inflation. As people make more money, people start to charge more for items, and then the Fed starts to step in and try to reduce inflation and keep it around 2% or lower. So then they'll start to increase the interest rates on everything, so it makes borrowing money to invest in your company or to buy a house or a car or any other types of items. Those higher interest rates make it a lot more expensive to buy things, so people start to buy less. Short-term interest goes higher than long-term interest, so the yield curve inverts. Then gross domestic product, GDP, starts to decline. You start to see layoffs and people lose jobs. Therefore, the family income goes down. As you have less income coming in, you can't spend as much, so you stop buying as many things and less things get manufactured. And then you have actually deflation instead of inflation, or a lower inflation rate, potentially. And then you go back through the cycle, and then in order to try to get people to start buying things again, like houses, cars, computers, to invest in companies, things like that, the Fed then reduces the interest rate, which makes buying things much cheaper on credit. And then you just repeat the cycle over and over again. You may have heard on the news that people are worried about the yield curve, and they're talking either about the 10-year and the 2-year Treasury, or the 10-year and the federal funds rate, which is the daily interest rate basically. The reason for this is because typically, more often than not, when you do have a yield curve inversion, it's a leading indicator that a recession is likely to follow in the next year or so. Here they've also listed the year that there was the first yield inversion and how many months until there was a recession. In 2019, we have actually inverted this yield curve already. From Nationwide, in March of 2018, they believe that we are somewhere in the late expansion, now being August 2019. I think we're much further along in this expansion. So there's concern that in the near future we will hit a recession. When consulting UBS, listed the US cycles from 2002 to 2008, going through contraction or recession, early phase expansion, mid-phase expansion, late phase expansion, and then in 2007-2008 return to contraction or recession. The current US business cycle estimate, they have the recession ending around 2008 in the fourth quarter. We start the recovery phase, And then from 2011 to the end of 2018 being in the mid phase, and we're currently in late stage expansion. Fidelity put out a white paper on the business cycle approach to equity sector investing back in January of 2017. I think this is very useful. Fidelity put this out, and I believe we are in the late phase of the expansion, as you can see from the other sources I was looking at. So things that do well in late phase expansion were usually consumer staples. So these would be things that regardless of how much money you have or don't have, you still need to basically brush your teeth, comb your hair, shampoo, conditioner, toilet paper, things that no matter what you always need. Energy, this could be oil, natural gas, things like that. Healthcare, so pharmaceuticals and other healthcare type items, materials, building materials and whatnot, and utilities would be electric, water, things of that sort. Consumer discretionary, as you can see, it's things you don't necessarily need, but maybe you like, maybe it's... So those are the first things to be cut as soon as you have a recession. IT, you have less and less people investing in IT as you're going into a recession. Businesses stop investing money in their computers and software and things like that, so IT usually takes a hit. Now, if you know that you're around the late stage of an expansion, or at least you believe that, and you want to take advantage of what will do well during a recession in terms of stocks and whatnot, you may want to start building a portfolio that has a lot of consumer staples, healthcare, telecommunications, and utilities. If you still have a lot of industrials, IT, finance, and materials, you might want to start reducing that before the recession hits. Now, when you're in the recession and you think you're about towards the end of the recession, you want to start looking back at consumer discretionary, financials, industrials, and IT, as these will be the things that rebound the most during the early phase of the expansion. And then you're going to want to dump some of your energy, telecommunications, utilities, healthcare, consumer staples. So Fidelity put out a update from June 2019. As of April 2019, Fidelity pegs the US in a late expansion phase, as well as most of the other countries of the world. In China, that's going through its recession or its contraction of its GDP. When looking at world GDP, the United States is still expanding, but starting to reduce the rate of expansion. And many of the other countries are right around zero. Most of the world economies are looking at close to zero on their GDP expansion. Some have already gone negative. When looking at real GDP for the United States, it has increased from 2015 to about 2017, 2018. We just got data back for Q2, and we're starting to see a reduction in real GDP. So the Fed is trying to counter this by reducing rates. In 2018, we had the benefit of having our corporate tax rate as well as our personal income tax rate being reduced. And towards the end of 2018, we had the issue with increasing interest rates, which seemed to cause negative issues in December of 2018. We are now having some loosening of the interest rates, so they're starting to reduce the interest rate on the Fed, and they're debating how much more they want to reduce it to try to prevent going into a recession. The balance also has a good outline of what to invest in or what not to invest in early, mid, late, and recession phase. the consensus is that we're already in the late cycle phase. According to the balance, the best sectors to invest in are still energy, utilities, healthcare, and consumer staples. So again, from Fidelity Investments, a common theme in the late stage and into the recession cycle is that consumer staples, healthcare, and utilities do well. Once you get into that recession cycle and you're getting towards the end of that, you want to start looking at where should you invest next. That would begin the early cycle in the financials, real estate, consumer discretionary, technology, industrials, and materials. And then as you go into the mid-cycle, technology as well as communication services tend to do well. If you'd like to see more of content like this, please subscribe. Leave comments and questions in the comments section, and I'll get back to you as soon as I can. Always remember that investments will carry risk and you can lose some or all of the money that you invest. Stocks over the long run, like such as the S&P 500, have generated about 12% returns year over the last 30 years, which is significantly more than what the current interest rate is for CDs and other money-saving assets, such as CDs, savings, and money markets, which are currently under the FDIC, which would be your Federal Deposit Insurance.